and welcome to the first QEO of 2026. As always, we have a theme. You can see you've got a dynamic looking snowboarder, kind of like heading down the hill. Thought we'd go for a Winter Olympics theme this time. And it's designed to kind of get across the idea that we think we are at the stage of the cycle where the economy is really picking up. And hence our kind of like theme is picking up speed. So we think that based off the data that we saw second half of last year and the indicators that we're seeing coming into this year, that this is an economy that has turned the corner, is starting to turn up. And the questions are really going to be around the durability and the sustainability of the recovery as we go through 2026 and beyond. That's a positive view, I guess, relative to what we have actually experienced in the economy in the last couple of years or so. But as I'll explain as I go through the discussion, we've got good reasons to kind of believe that that is going to be the case, given that we have probably all of the major factors that we would expect to underpin a recovery in the economy this year, perhaps that weren't always all there last year. I'm going to firstly start talking about the world that we live in and how that's impacting on the New Zealand operating environment. Lots of interesting things going on out in the world, particularly in the United States, but also more broadly as well. Then I'm going to focus on the domestic growth outlook, basically what we think the economy is doing right now and it's going to do as we go through the next couple of years, the drivers of that. Then I'm going to talk a little bit about some issues around the sustainability of the recovery. And that's going to really focus a lot on our view of the labour market, I think. But it really comes down to kind of thinking about, well, what is it that we think will cause the recovery to have legs this time? Because we have seen in the last couple of years that the start of the year has actually started to look reasonably promising, but then growth sagged in the middle of the year. So what is it about this year that we think is potentially a bit different that might mean that we have a better, more sustainable growth period as we go through from here? At the end of that, we'll be talking about what we're thinking about inflation and particularly how the Reserve Bank is going to respond to this outlook. We're basically had a period where the Reserve Bank has cut interest rates significantly to pretty stimulatory levels now, I suppose, and then the reasonable question will be, well, what happens next? When do rates have to start rising again, and what does that cycle look like? And then the last thing, I would be remiss if I didn't really talk about risks as well, because there's plenty of risks, I think, in both directions out there of the economic outlook right now, especially in election year. So, global backdrop. Pretty important in determining the operating environment we have here. And if you casually look at this table, you'll see a lot of arrows that are pointing up. Actually, the only one that's really pointing down there is one to do with Australia in a couple of years, and I've got a bit more on that later on. But generally what we've actually seen is a period where economists have gradually upgraded their views of how foreign economies are going to operate. In both the United States, but also through Southeast Asian trading partners, and even in Australia, things have actually perked up a little bit in the short term as well. The one area where things haven't perked up too much is in China, where we basically have the same numbers in that we have had since the last few months or so. The reality with the Chinese situation is that they're still mired in the same structural challenges that we've been talking about for a while, where that domestic economy is still not really being stimulated adequately, so they've still got high unemployment, falling house prices, real challenges to the consumer there. But at the same time, though, aggregate growth has managed to hold at around the 5% growth target that the authorities have been aiming for, principally because they've been exporting like crazy to the rest of the world. And that's pretty much the go-to strategy that the Chinese authorities have with respect to growth. They tend to not rely very much on domestic growth. They rely heavily on feeding the domestic demand coming from other countries. In aggregate, it's not really shifting the dial very much there in China. Trading partner growth now is forecasted to be sitting either at or slightly above 3% for the next couple of years. That is fairly decent. It's lower than where the average was before COVID. But the real difference there between where we are now and where we were before COVID is that China is no longer a 7% economy. It's a 5% economy heading towards a 3 to 4% economy, and its weight in the global economy basically means that in aggregate global growth forecasts are just not as strong as they were through the 2010s when China was really going ahead. The other thing I'll point out here is there have been some really significant upgrades in global growth if you think back to where growth expectations were at their weakest in April and May last year when we first heard about the new tariff policies coming through from the United States. At that stage, I think every economist would have been telling you that the growth situation for the world for the balance of 2025 and through 2026 was looking pretty bleak because of the impact of those tariffs on global trade and the potential for retaliatory action from other countries. But actually it's turned out that that hasn't come to pass at all. I'll explain to you in a bit. There's been the global economy's managed to shake that off, and as a result, if we look at the pattern of how economists have been thinking about how the world's going to evolve, it's took that dive there in April, May, and then it's just been one-way traffic since then, as actually things have not been as bad as people feared. Partially because Donald Trump didn't do everything that he threatened to do. Partially it's because the global economy was able to adjust to what was going on. And importantly, we didn't get that retaliation coming from other trading partners as well, which would have made the whole situation a whole lot worse for everyone. We are in a situation now where global growth forecasts are stronger than they were at the start of last year, before all of the Trump kind of administration issues really started to come to play. So that's pretty positive, really. So why is this? I was standing up here talking about some pretty dark potential stories about what could happen to global growth coming from tariffs. I mean, I'd like to think I was probably a bit more optimistic than the average punter, but it was still pretty scary times out there where bad things could happen. And I think the first thing to keep in mind that has surprised economists, and we shouldn't really be surprised that economists get surprised, because the factor that we focus on is generally not the thing that actually really happens. And in this particular case, what has happened in the last year is that this AI tech boom has really come on strong. And it's driven a really strong degree of investment around the world as companies are looking to leverage these exciting new technologies that promise quite a lot in terms of boosting productivity. So this is an example from the US GDP data where you can see that investment in ICT equipment, that's all your data centres and all of the other bits and pieces that go in to generating that AI infrastructure running at 20%. It's a significant boost to activity. Not so much directly, because like a lot of that investment is imported, because a lot of that stuff isn't actually produced in the United States, but it is generating a lot of activity more broadly in the economy and through our trading partners, because that supply chain that feeds this ICT investment boom is a global one. It's not just in China, it's not just in one country, it's all around the world. And it really has been an important offset to what otherwise could have been a weaker year last year and coming into this year. So this brings me to my first question of the day, actually. Which of these statements do you think best reflects how you think AI will impact your business or workplace in the coming year? There's a few options here. No particular impact, aside from maybe your Google search might be a bit better. Do you think that there'll be a reduction in costs because staff will be replaced by AI applications? Do you reckon the firm is actually just going to be able to grow and produce a lot more by being more productive, making existing staff more productive? Do you think that the mix of staff might change as the business tries to maximise the impact of AI? Or do you reckon your business is going to be a bit rooted here because, basically there's somebody who's doing it better or faster, or you're in a business where you're actually quite ripe to be disrupted by AI, and as a result, things won't go so well. So give us your view, A through E. Actually, that's a pretty encouraging set of results. I mean, basically, I think you're emphasising that there will be some productivity benefits here from AI, which means that you'll be able to do more with what you got. I think that's probably closest to where my view is here. We have got the Copilot AI enabled in the bank here now. And I'm confident that the main impact of it on me is going to be that I'm going to be expected to do a lot more. I don't think that they're going to have half a chief economist just yet. I don't think we're going to get a virtual chief economist just yet. But I think that is probably how it is, as it has been with almost every major technological advance we've had to deal with in our lives. And I do totally get this point about there needing to be a change in the mix of staff and skills required, because it absolutely is the case that if your role or you've got roles in your business which are easily automated, if things that are being done are just following perhaps relatively rigid rules or steps, well then that stuff can be automated with things like AI agents and things like that. So that basically does mean that you'll be looking to tilt the mix of people you've got working for you to kind of maximise the benefit of that. So what else has been going on apart from AI? Well, the global trade thing, this big disruption that occurred, I'm actually not saying that it didn't have an impact. It did actually have an impact on the global economy. And it's most obviously evident in the patterns of trade. And here what I'm showing you is basically how Chinese exports in particular have been influenced by what's happened with the trade war that was going on last year. China in particular was the country that was really in the gun here with what Donald Trump is up to, and will continue to likely be in the gun for the time being. And the response to that has been quite stark, where, as you would expect, there has been a significant decline in exports coming from China into the United States because it's no longer as competitive to be able to do that given the level of tariffs in play. But look at how the Chinese have been able to compensate for that by exporting to other regions. And indeed, in aggregate, Chinese exports have not gone backwards. They've actually gone reasonably strongly forwards this year. That's the reason why I was telling you earlier that Chinese GDP has managed to hold up. So what this is telling you is that global business has tried to optimise around the new tariff regime, and it hasn't really significantly undermined aggregate demand around the world. What it has is just shifted where stuff is happening. I think there's probably a fair degree of trade redirection that's gone on here. Stuff that has actually been made in China is no longer directly going to the States. Instead, it's going to another country, maybe having a few things done to it before it goes into the States, and therefore doesn't get treated as a Chinese good. But all that just tells you is that, as you might expect, markets are actually quite effective in getting around some of these administrative type rules that governments try to impose. So that's pretty impressive, I think. The other thing I will say, though, about this is that what has happened is the global supply chains have had to be retooled here, right? They are different than they were at the start of last year because of the tariff regime. And that has probably come at a cost. In fact, you can probably logically work out that would have come at a cost, because if it wasn't the case, then they would have been doing it anyway, right? So as a result, one of the other stories that we heard in the middle of last year is, oh, watch out, there's going to be a wave of cheap goods hit the global markets as China furiously tries to export outside of the United States, pushing prices down everywhere. And the reality is that just hasn't happened. Import prices haven't been rising very strongly, if you look at what's been going on around the world, but it hasn't been the case that we've had this large deflationary shock. Partially that's a consequence, I think, of the fact that demand has remained reasonably resilient around the world. So there's been buyers for the stuff that China is trying to sell, but also it is more costly to kind of like operate businesses in this new environment, and those costs have consequences. If I think about what's going on in Australia or other major trading partner, I mean, that is actually quite an interesting story. Australian economy has actually been unexpectedly strong in the last 3 or 4 months, 6 months really. Their housing market is doing 10%. Housing credit has grown really strongly. The unemployment rate is at 4.1% and been falling, so it's quite low and below where the RBA thinks the NIRO is. They don't think, the RBA doesn't think that there's any excess capacity really in the economy, and as a consequence, inflation is quite high as well. So we've been in a position there where the short-term indicators are pointing us towards a stronger economic performance from Australia in the short term. But if you think back to my table at the start, we've revised down our growth forecast for Australia a couple of years out. And that's because we think the Reserve Bank of Australia who's going to have to step in here and bring inflation back to target. You know, annual inflation is sitting in the sort of 3.8% range right now, which is above the 2 to 3% target. And it increasingly looks like a bit of policy action is going to be required to restore the Australian economy back to getting inflation within the target, which I think has been a big surprise to everyone. Markets, for example, middle of last year, were actually thinking about rate cuts in Australia. Now they're thinking about rate hikes. The other thing, tariffs. I mean, in the weekend, we got plenty of news about tariffs, as we tend to do. I think should reasonably have been expected. The Supreme Court did step in here and say that the IEPA tariffs, the reciprocal tariffs that were imposed on most countries, including New Zealand, were illegal. They were unconstitutional, and the Supreme Court was fairly clear about that. So they have been rescinded. In the short term, the US has responded by imposing a new set of tariffs under a different authority, currently actually set at 10%, despite the fact that there was a tweet from the President on Sunday that it was going to be 15%. Interesting that happened, but only a temporary authority. You can only do that for 150 days. It's like playing for a bit of time here while they work out what are they going to do with this tariff policy, because they absolutely do want to keep this trade war going, particularly against China. Because they can't use this particular statute, which pretty much gave them high degree of discretion on how much they charge to who and for what reason. Now they're having to appeal to other statutes which require you to justify a tariff on the basis of a national security concern or potentially unfair trade practices and a significant trade imbalance. Now, there are some countries like China where that will fit the bill nicely, and I'm sure they'll get their fair share of tariffs. But most of the stuff New Zealand exports doesn't really fit very well into these categories, I think. I've joked before that perhaps a bigger national security concern is the Americans' inability to get a hold of a cheap bottle of Sauvignon Blanc on Friday nights. More generally, I think in election year, it's going to be quite hard, I think, for the President to make a strong argument for imposing tariffs on food products, which is what we export, due to the focus on cost of living concerns. So I think we may find that we, at the very least, have our upside risks on tariffs reduced. You know, we were on 15, now we're on 10, perhaps we won't be on 10. In 6 months' time. And certainly those risks that you wake up one morning and Donald Trump says, I've just noticed New Zealand exists and you guys can have a 35% tariff because you bet us at the cricket or something. I mean, that's not really likely to happen at this stage, unless they find some kind of national security type issue. So most of that stuff, I think, just de-risks the trade environment a little bit, without saying that there is not going to be any uncertainty, because sure as eggs, this afternoon in the State of the Union address, Trump will have some things to say, I think, about his flagship tariff policy. So getting into the growth outlook, how do we think New Zealand's going to go this year? And here's my second question of the day. What factor do you reckon is likely to drive an increase in spending in 2026? And you can think about it from your own perspective or that of your business. Is it going to be house prices growing? It's going to push things along. Are you going to be seeing an improvement in job security that maybe kind of like helps increase spending? Is it going to be another great year for the exporters, which means that there's plenty of money rolling into the regions? Is it the level of interest rates? We've got 2.25% OCR right now, pretty low, pretty stimulatory. Everybody seems to agree on that. If that sticks around for long enough, is that going to be the thing that pushes you forward? What about the election? Is that going to potentially be something that as we get a bit closer to it, you get better certainty, worry a little bit less about it? Or what about, is it going to be something that happens out there in the world that really kind of helps push confidence and spending, reduces uncertainty? Let me know what you think. Yeah, so if I look at those sort of results, that makes sense to me. Actually, I kind of wondered if people might rate improvement in the job market as potentially being a more important driver. Certainly the Reserve Bank really did emphasise that point in their monetary policy statement last week. But I think it is probably fair to say that the thing that we've got going on this year will likely improve the growth outlook and give us a bit more certainty relative to the last couple of years, I think, is the fact that this year, as well as that supportive exchange rate, a decent global growth backdrop, and decent commodity prices is we do have interest rates that are quite low now. So that should ultimately be one of the things that really helps underpin the outlook as the year goes on. We talk a lot about long and variable lags in economics. August 2024 was when the first cut happened. The big cuts really came along at the end of 2024 and the start of 2025, and we're only really about a year long from that now. So I would expect to be seeing something tangible coming out of those things, and I think the data increasingly tells us that. So if I look at our growth forecasts, I think the big change here is that there has been an upgrade, particularly because we got stronger than expected growth in the September quarter when that data came out before Christmas, 1.1%. And most of that we thought was like a reasonable indication of underlying momentum as opposed to kind of one-offs. And we expect that the economy will continue to operate at that sort of 0.7, 0.8, 0.9 type pace as we go through this year and into the start of 2027. That means that economic growth is expected to be 3.3% for the year. That compares favourably to a potential growth rate we would say would be closer to 2. So basically this year, if that scenario pans out, then we would expect to be using up the substantial excess capacity that's sitting out there in the economy now, and we will probably have used it all up by the time we get to the start of next year. So that's pretty positive. Interest rates are a key driver of that, but we can kind of see that if we look at the tone of business and consumer confidence, that these are both pointing in the direction of expecting better growth outcomes compared to what we've seen through most of the last year or so. Business confidence in particular has been quite interesting. Ever since interest rates started to get cut, back in 2024, businesses started to tell us that they were optimistic about the future. But it's only been quite recently that the surveys have told us that they've actually been experiencing better business conditions in recent months. And that seems to be quite well correlated with output and GDP. It gives us greater confidence that what we're seeing here is going to be real and potentially sustainable. And we can even see the consumer starting to poke his or her head above the parapet a little bit. That chart there basically shows that consumer confidence is just poking up towards that 100 level. I think it's a bit questionable whether there's a long-term downtrend in consumer confidence in that. But what we can say is that consumer confidence is stronger now than it has been in 2 or 3 years. So hence we do need to see that situation of improving spending appetites, I think, to really give some legs to this recovery. Outside of general confidence, what we have noticed is a few sectors that are actually performing pretty well. One that's really surprised us is in the construction market, actually, where we've seen quite a significant lift in consents for about 6 or so months now. And it really is starting to tell us that the construction sector is in the process of turning up. And I think this surprised us because we haven't actually seen house prices turn up. And normally we would expect to see house prices move first. Now, what this is, I think, telling us is firstly interest rates work, because this turn up in building consents does correlate quite nicely for the interest rate cycle, if you give it a bit of a lag. And also it tells you that perhaps there could be some positive impacts coming through from the changes in planning rules that have occurred around the country that has helped facilitate a change in the nature of the housing stock away from sort of like large single family homes to more townhouse type developments. We can see that absolutely in the data. So you're getting quite a lot of activity going on as builders are responding to conditions by basically buying those older houses, putting more housing in, be able to price it at a price point which is more affordable for buyers, and that's generating activity. One of the things I noticed when I did a calculation of this concept called Tobin's Q, it's basically the ratio of the cost that you could sell a new house now versus how much it costs to build. And that ratio is above 100 now, which is kind of interesting because like usually at the bottom of a cycle, it's not. It's usually low, and it's one of the things that really drives a bigger cycle in the construction sector. There have been quite good incentives, I think, out there for builders to provide new houses. And as a result, if you look at the track of that red line of building consents, or even where work put in place in aggregate actually is, it's sitting some margin above the really low levels that it got at the end of in the middle of the GFC cycle. So that's pretty decent. The other thing I'll say is tourism is actually moving on ahead. We can see that particularly represented in some of the performance of the regions out there, which are really benefiting from tourism. Not so much Auckland right now, but perhaps this year with this new conference centre, convention centre opening. The highlights there is that we're getting a lot more visitors, Kiwis living overseas, coming back for holidays. You've got to come home and see mum at Christmas. Australians are turning up because their economy is growing great guns and the exchange rate's a bit lower, so Queenstown, glass of wine there doesn't seem like a bad idea. And also we're getting a lot of US visitors as well because their economy is still performing quite well and that exchange rate is quite supportive. We've even seen a bit of improvement from the Chinese, which currently are sitting at the bottom end of the list in terms of where they are sitting relative to the 2019 pre-COVID level. But there has been decent growth in the last few months, suggesting that actually they're starting to get interested as well. So that's been quite helpful, I think, for aspects of the hospitality sector and the regional economies leveraged to that. But more generally, what we're also seeing is that the export sector has really made a decent contribution up until the end of last year. I mean, this just breaks down where we've seen exports going. You see we've got a very strong level of exports in Q3 and we're expecting that again in Q4. Food exports, that's that kind of dairy and meat sector, big drivers of that. But actually there's quite a lot of other contributors, including in the services sector where we're increasingly seeing a positive contribution for some of those higher profile services sector firms. Think about your Xeros, your Rocket Labs. When they send a rocket into space, I mean, the value add of that sheets back to New Zealand because that's a New Zealand-owned firm. We're increasingly able to see some of that in the statistics as well. That's what you should expect to see when the exchange rate is relatively supportive because it makes New Zealand a good place to contract some of these services from. The dairy sector and generally the commodities sector is continuing to perform quite strongly. We had a bit of a hiccup in dairy prices in the last few months of last year where they went down quite a bit. Fonterra cut its payout from 10 down to 9 forecast. We cut ours down a bit as well to 9.30. But actually there's been a fierce bounce back in most of those futures markets as we've gone through this year so far. To the extent to which Fonterra's back revising up again, we've probably got upside risk to our forecasts. This year's payout is actually getting more precisely understood now. It's probably going to be in the $9.50 to $10 range, given that most of the milk's been sold. But it will be interesting to see how the forecast payout for next year starts to evolve. And it still looks to me like we're basically in that sort of quite high range, up near $10. Given that even though there's plenty of supply out there in the world, there's clearly plenty of demand for these commodity exports we're selling. The underlying driver, I think, of this optimism, as you correctly identified at the start of my survey, is that it's the interest rates that are really helping to push things along. Increasingly, people have been able to transition from those higher, older fixed rates to lower, newer fixed rates. There was a real bun fight in the mortgage market in December when the cashback kind of like bank refinancing deals were all available. A lot of people refinanced in that month and got a better rate. There was so big a data, actually, I looked at it initially, I thought somebody's made a mistake here because we've never seen numbers that large, but apparently it was actually true. And basically we're going to see continued inflows into household budgets as interest rates continually move on to that kind of 4.5 to 4.75 level. But also importantly for new marginal borrowers, they're in an environment now where interest rates are actually pretty low. So therefore it does encourage activity. Interest rates are a little bit higher than perhaps where they were in the wholesale markets, perhaps at the end of November, but not really materially higher, so still at quite stimulatory levels. Often people ask, well, what about productivity? Is there anything going on here to suggest that anything's really on the improve? These are measures of productivity, and I guess my short answer is not really. We basically think that we've still got relatively weak levels of trend productivity, and you can kind of see that in those blue arrows on this chart. What we do expect to see, though, is that there will be a period where output runs ahead of labour input. Basically, I think firms were holding on to a few staff that they didn't need so much in the last couple of years. And I think they will take the opportunity, at least for a while, in 2026 to work people a bit harder to get some of that output back. So that'll be measured as an improvement, a cyclical improvement in productivity, but we don't really have anything in the forecast suggest that there's anything kind of structural that's changed there. So the sustainability of this recovery. Let me ask you a question. How sustainable is it if we think about the labour market? Thinking about, say, the middle of this year, how many employees do you think you'll have? Do you think you'll have less, about the same? You're going to work them a bit harder? Or do you reckon you might hire a few more? There we are then. Okay, so at least the fewer is a lower category, I suppose. About the same. People not really feeling it. I think probably in the labour market is probably a sense I'm kind of getting there. I think I can probably understand that because we are at the very early stages of, I think, a recovery in the labour market. What we tend to find is that the labour market lags increases in activity by a bit. We actually did see some growth in jobs in the last few months. We had 0.5% employment growth in the fourth quarter, which was a pleasant surprise. But we really don't think that employment growth is going to hit its straps for another couple of quarters yet, as that period of uninterrupted above-trend growth really starts to mean that there'll be improvements in job security and ultimately hiring. We anticipate that the unemployment rate is going to fall back over the course of this year. We think it'll end this year closer to 4.7%, heading down towards 4.4% at the end of next year. And that is reflective of the fact that we are assuming, we have a forecast that actual growth is going to be running ahead of potential growth. So therefore we would expect a falling unemployment rate in that environment. One of the things that will help support growth is that we will probably see a pickup in net migration. Right now, net migration is basically showing signs of bottoming, but it's not really rising that very much, and that kind of makes sense if you think about the labour market being still relatively in the early stages of recovery. But as that recovery starts to build up, we will start dragging in more people from overseas, which will help boost population growth, and that'll help support growth in its own right. But also importantly, I think it will probably reduce the degree of outflows of New Zealanders overseas. So this is a chart here that just highlights the largely cyclical relationship that we see between the net flow of New Zealanders overseas to Australia and the difference in their unemployment rates. The forecasts here are a combination of our forecast for the New Zealand unemployment rate and the Reserve Bank of Australia's forecast of a rising unemployment rate in Australia. Doesn't really appear right now that is a great time to head off to Sydney to start a new career compared to perhaps what might have been the case in the last couple of years. So the inflation outlook, what does all this mean? Well, our starting point for inflation is not that comfortable. It's over 3%, although the Reserve Bank sounded pretty relaxed about that when they talked to us about it last week. And we do expect that inflation will drop back this year because some important categories like food prices are unlikely to rise at the sorts of rates that we saw last year. But you can sort of see from that red line there that we're not expecting inflation to drop back too far. We think it's probably going to hang around in the sort of 2.2 to 2.5% range over the next couple of years. So it's not like we're going to be undershooting the target. It's going to be a situation where we do expect some further reductions in domestic non-tradables inflation because we still do have a lot of excess capacity in the economy, but we won't necessarily we might still see tradables inflation remaining relatively robust as those foreign cost pressures pass on through to New Zealand, as the exchange rate remains relatively weak as well. Looking forward, like this is the graph that if I was working at the Reserve Bank I would never show you, because we never like to admit when you're at the Reserve Bank that there's a level of unemployment that you need to do your job, but it is the truth nonetheless. So if we think about a NAIRU estimate, the point at which the labour market isn't really adding or subtracting to medium-term inflation pressures, we can sort of see here that it's probably sitting down there in the low fours with unemployment rate above 5.4%, well then obviously that will be putting some downward pressure on wages and medium-term inflation pressures. But that period of above-trend growth, the falling unemployment rate brings that into balance relatively quickly. And indeed, our estimates of excess capacity suggest that it'll be largely gone by the start of next year. Normally, Reserve Bank would probably be tightening monetary policy a bit earlier than that. In our case, though, we think this time the Reserve Bank seems to be very happy to sit pat for most of this year. We've still got a rate hike sitting there in the forecasts in December of this year. Reserve Bank seemed to broadly signal that sort of stance. They sort of said that the market was getting a bit ahead of itself by pricing more than one rate hike this year, but that one seemed like a reasonable bet, albeit not a done deal. And I can understand their perspective in that regard. Why actually take that risk of being too prescriptive about what you might be doing in 9 months' time, because there's quite a lot of water to go under the bridge, I think. You'll see markets are pricing in pretty much something close to what we're forecasting. Where I think things get a bit more interesting is that once those tightenings start at the end of the year, I think the bank will be moving relatively quickly, because 2.25% interest rates are stimulatory, and by then they will have determined that they don't need stimulatory interest rates anymore. Moving them up to 3 to 3.5%, I think, will be more or less the base assumption that you should expect to happen relatively quickly. And I think that the time taken by keeping interest rates stimulatory this year to make sure the economy recovers will probably mean that they need to take interest rates up a little bit above sort of like neutral levels through 2028. And we've got an assumption there that they peak at about 4.25% over that year before ultimately returning to 3.75%, which is where I think is probably a closer level of what a kind of like a neutral stance actually is. You can see there from the Reserve Bank's forecast, they're a lot more cagey than that. They never really tell us the truth about what's going to happen in 18 months' time, partially because they probably don't really know what they're going to be doing in 18 months' time, which is probably reasonable. So risks, the big one, housing market. I've got a whole row of institutional clients saying, Kelly, this economy is not going to be able to grow if house prices don't rise. And house prices haven't been rising, so therefore we can't grow. That is pretty much the thesis I hear. We actually do forecast that house prices will grow this year. We think we'll get 4% this year. I think that's probably a bit above what most forecasters have, certainly above what the Reserve Bank put last week, where they said it was going to be 0. And I think it'll grow 5% the year after that, particularly as that economy has gained momentum, that unemployment rate has fallen, and importantly, population growth has picked up. So this is actually generally, I think, a pretty subdued picture, because if you look at what usually happens in this economy when you have a period of, say, 3% or so growth, you would probably see something like 7% house price growth. This is just a scatter plot of annual growth in house prices, annual growth in GDP, last 25 years, put a trend line through the middle of it. So 3% there basically says it's tended to be more like 7, because the long run average, I think, has tended to be closer to 6.5% and 7% house price growth. So we don't really have as strong a forecast as what might be consistent with the 3.3% growth forecast that we actually have. We don't think this is going to be a housing-led recovery. In fact, I've been calling it the houseless recovery. Other things are really going to be contributing here. I think Reserve Bank agrees to some extent. I think where we differ is I find it pretty hard to believe that house prices won't move at all if the economy is going to grow at 3. Normally if the economy grows closer to, say, if house prices did 0, then you would probably only see about 1.5% growth in a year. And if that's the case, that would be another disappointing below-trend year. I don't think you'd see a fall in the unemployment rate, and we'd probably have another year of disappointment. And I'm just not sure that we really have the economic conditions in place right now, absent, large shocks that are going to mean that happens. And then that just leaves me, my last slide, before I'm going to hand off to Imre, who's going to tell us what markets are going to do. The bogeyman we've got this year is the election coming on November the 7th. Pretty high degree of uncertainty here about what's going to happen, because the polls are pretty close, so anybody could win. I think we're going to see some pretty diverse differences of opinion in terms of policies that are going to be enacted. And as a result, it may be plausible that business gets to the second half of the year and goes, I'm not sure who's going to win here. Maybe I'll just take a step back and wait until I see what the result is. And if that is the case, then, we will basically end up in a situation where perhaps the economy does slow a bit in the second half of the year. I personally don't think that's very likely. I suspect what will happen is that if the economy's got a decent head of steam going by the middle of the year, that people will just shake that off and get on with doing their business. But it is really going to be about choices about what this line does. This is the share of government of GDP. The existing government has basically held, I suppose, that share in the last couple of years. There hasn't been widespread austerity, but it stopped rising. The question will be, what do people want to vote for after that? Is it going to be rising share of government again, or is it going to be something more like the consolidation picture that we have in the forecasts, which suggests that we might see a sliver of a surplus in 2029 or 2030? So with that, I'll pass on to my colleague Imre, and he can tell us about the markets.
And like you said, for economists, strategists, market strategists have not yet been replaced by AI agents. So I get to stand up here and do human predictions, which I've always enjoyed, better or worse. And here they are for the next quarter and beyond. I'm going to talk a little bit about the longer term stuff as well. But broadly, in terms of direction, Kiwi US should end the quarter ahead a bit higher. I'm putting about 62 on it. Looking much longer term for the next year or two, we think that uptrend is going to be the prevailing direction. So a bullish Kiwi, medium and long term. Kiwi Aussie down probably for at least the next few months, but sometime in the second half of the year we do expect a reversal. I'll talk about that in a bit more detail later. But for the quarter ahead, pointing down still. Interest rates, with this long on hold period looming, it's not going to be that exciting talking about directions of interest rates, but the short-term stuff, just a lot of volatility and noise, and maybe ending the quarter a little bit higher than when we are now. And the longer term, the 10-year swap, no reason to think it should be any much different to what it is right here and now. Which means that over time, and this has been a view that we've had for a while, and it is in motion, and this is going to continue for probably a couple of years, yield curve will flatten. Right, a little bit of detail then, starting with Kiwi US and always the look back, holding ourselves to account, good, bad, average predictions, not bad, I reckon. We had a two-tone, down first, then up. That was about, Kiwi economy was still considered to be somewhat on the dog box for most of last year, right up until about October, November. And that's about the time markets turned around and started recognising this better data that Kelly talked about. That started popping out from about November, certainly in December. And so we got this rebound in the Kiwi. That was expected. Went a bit further than we expected. What was that about? Mostly US dollar stuff. In particular, that big jump near the end of the horizon, that was mostly about Trump saying he's going to take over Greenland. So weird stuff like that caused a bit of a flight out of the US dollar, and therefore everything else kind of went up a lot. So yeah, so that was the past, and I say looking ahead, near term, next few weeks, there's been a little bit of global risk aversion kicking around. Also had the Reserve Bank last week. They sprung a slight downside surprise to the markets. They weren't as hawkish as the markets expected. So those two things maybe ripple through for another couple of weeks and we get a bit of downside. I wouldn't expect any lower than about 58.5 though. Longer term, finishing the quarter higher, I think we could get up to around 62. And beyond that, year ahead, we've got a forecast of 65. And 2 years ahead, we're that good, we've got 68 on it. I'd put very low confidence on that number. But what's probably the more important thing is that our trend over the next 1 and 2 years is clearly pointing upwards. And the main story behind that, apart from this increasing Kiwi economic recovery story that Kelly's talked about, is also this expected continued weakness in the US dollar. Probably three things you could pick on there. It's been overvalued actually for quite a long time, so that's hanging over it. We're expecting more easing out of the Fed during the year ahead, And thirdly, this is debatable, but you could argue that there's been some structural damage done to the credibility of the US dollar as a safe haven or a reserve instrument globally. And there's been some evidence of a little bit of a shift out of the US dollar as a result of the stuff that's come out of the US administration over the past year, in particular the chaotic tariff rollouts, but it's more than that, it's attack on institutions and all those things. And they basically just chip away at the credibility of an upstanding currency like the US dollar. So we think that's going to be a trend for a while, and that really is the basis for our up Kiwi US view for the longer term. And here's some credence to that. Just over the last year or so, I like to sort of point out major events that cause movements in the US dollar. And you can see that Kiwi US is almost a mirror image of the US, so it's very much it reflects whatever the US dollars are doing. The really big story you can see started with Trump's inauguration. That's when he rolled out for the first time these fairly severe or fairly outlandish policies, in particular regarding trade. And as they rolled out, and you had Liberation Day in April, that caused a big fall in the US dollar. And then, that trend really just persisted all the way through until about January of this year. We hit a 4-year low in the US dollar. That's in the broad US dollar. Over the last month, that's stabilised a bit, but we do, as I say, expect that downtrend in the US dollar to continue. And if it does, clearly Kiwi US must rise. Right, on to Kiwi Aussie, our second most important currency in terms of volume that we see. Last time around, we really emphasised this contrast between the Aussie economy and the Kiwi economy and what it would mean for the respective central banks. And that's certainly coming to pass, or has come to pass. We expected the cross to fall, so it did. Probably fell a wee bit more than expected. That's probably down to that the RBA kicked off a rate hiking cycle, and it's the first G10 central bank to do so in this set of tightening cycles. Other central banks will be thinking about it in due course, but they're way behind. US has still got a couple of cuts to go before they start. And as I say, we're not going to start till December. So they started at the beginning of February, and we think there'll be another one in train in May of this year. Markets think there might be another one on top of that to come a little bit later too. So RBA rate hikes and a better economy, and that's really going to be the theme for the next quarter as well. And probably that'll remain the case, I think, until about the middle of the year, when there should, if all goes according to plan, be mounting evidence of this Kiwi economic recovery. So our momentum will be picking up. Sure, the Australian economy will still be strong, but it'll probably start to plateau in terms of strength, so a rate of change type things. So that's when we start to maybe shine a little bit more relative to the Aussie, and that's when we think we might get a turnaround in the cross. So longer term, in the cross, we've actually got to bounce up to about 89 cents in a year's time, if we get that turnaround. And just as to show you in terms of the interest rate spreads, which are the dominant driver of this cross. So this is a great cross to follow, because all you have to really do is just follow the interest rate spreads, and if you can pick those, you can pick the cross. Interest rate spreads right now, they're about 100 basis points below Aussie rates for the 2-year. And it's a similar story regardless of what maturity you pick. We're well below Aussie rates. We've hardly ever been this low. This is quite historical stuff. It probably hasn't got that much more room to go, because markets have priced in a lot of the good Aussie story, and there's scope to price in a bit more of the Kiwi story down the track, but probably not till about the middle of the year. So that's where we are now. We expect to see that interest rate differential bottoming out sometime over the next 3 to 6 months, and then turning around and then rising. And then our interest rate disadvantage will dissipate over time, we think, in the long run. Onto interest rates. Shorter term interest rates, 2-year swap. What do we think last time? We thought not much in the very near term, but eventually picking up. The bit about eventually picking up, that did come right, so I'll give it half marks for this one. Looking ahead, now we had this update from the Reserve Bank last week, and they did say they're going to stay on hold for a long time. Yes, the easing cycle's finished, they confirmed that. but don't expect rate hikes anytime soon. That means, I think, for these shorter term rates, like 1 year rates, 2 year rates, 3 year rates, they're probably not going to run away in a hurry in the next few months. I think we'll just get a lot of volatility, a lot of noise. But eventually, they are going to rise more persistently. I think they might actually end the quarter higher than where they are now. So the 2 year swap right now is about 2.95. So my guess is it will probably end the quarter just a wee bit above 3. But for the longer term, for the year ahead, we're expecting the 2 year swap to be above 4%. And I think that's the important thing you need to be aware of, that things like the 2 year, the 3 year and the 5 year, they're all going to be quite a bit higher than they are now in a year's time. A little bit of substance behind that. This is the usual picture I put up to show the latest Reserve Bank's own projection of its OCR, commonly called the track. That's the light blue one. So they did actually nudge it up last week, but only a bit. They only nudged it up by 10 to 20 basis points, and the market was expecting a lot more than that. So that was a small downside surprise. But still, they are clearly signalling a rate hiking cycle is coming. Now, according to that track, if you tried to interpret it somewhat literally, it would say that hiking cycle is not going to start till early 2027. We think it's going to be a bit earlier than that, in December. Market also agrees. You can see market here for year end has got a full hike priced in. And while there's not too much disagreement over the year ahead, beyond that, there is quite big disagreement. So the markets are thinking, Reserve Bank, nah, you're dreaming. It's going to be more than what you say. And so they've got that black line. And Kelly thinks it's going to be even higher than that. So, clearly the risk, you would say, to the Reserve Bank's track is in an upward direction. Now, there's actually some empirical basis for that as well. The Reserve Bank has been publishing this OCR track, or bank bill track, since about 2003. So they've had a long history of their tracks, and in every case where you had a major tightening cycle, they've started off with the track looking quite conservative and understated relative to the eventual actual result. They've always been behind the game, if you like. Now, that's not to chastise them, that's just saying that they're rather conservative at the start when they're going into a cycle for a whole bunch of reasons. I mean, right now, one of the reasons that they don't want to nudge that track up as far as the market is that it would clearly spook the market. And then you'd see interest rates rising a lot. That would spill over to things like mortgage and loan rates. That would tighten financial conditions, and they would undo all this good work of this economic recovery. So they don't want that. So you're going to have gentle rises all the way through. So come back to their next MPS, you'll probably see that blue line a bit higher, again in August, and so on and so on and so forth. That blue line, I think, will just successively rise. What will the black line do? Now, that's the most important one for your rates because that's what determines market swap rates. As I say, they're not too much in disagreement with the Westpac, but there's potential for them to rise at the longer end. But they will wait and see. This part of the black line here typically tends to rise when they see stronger evidence of this recovery. So we've seen early signs of it. It's not yet what they would call compelling. If we get to about mid-year and we're seeing a lot more evidence, then they'll be more confident and they'll be nudging that black line higher still. And that means that, that we're going to then therefore end up with higher and higher swap rates for 2 years and longer. But converting the Westpac OCR forecast into swap rates and lining them up against actual swap rates prevailing today, and knowing everything I've just told you about this rate hike cycle coming, and if you had a decision to make about hedging your floating rate liabilities, and you said, well, if I was to hedge today, are the market rates cheap, expensive, or fair? And which one looks like the best one to go for? You would look at that and say, they're not hugely different from the Westpac forecast, so you would call them close to fair. If anything, something like the 3-year rate is relatively cheapest compared to what's implied by the Westpac OCR forecast. So that could be one that you would plumb for. And I say could be because I can't give financial advice. I'm just saying if you're looking for this sort of exercise, this is quite a good way to do it. Nothing looks too outlandishly out of fair value, but the 3-year does look slightly cheaper than the rest in terms of a fixed rate, if that's what you were thinking about doing sometime soon. And to finish up, I put this up last time as well, just worth reiterating that we are now well and truly into an on-hold cycle, and probably we're going to be in it for a total of 14 months because we started in November, and Kelly says we're going to hike rates in December of this year. So 14-month on-hold cycle. Is that much different to the past? Not really. You can see the average is just under a year. Preemption of the market. Yeah, the market's going to be preempting it. It started rising from about October, so it's still the same case. The market will have preempted the hiking cycle by a total of about 14 months. Is that unusual? No, absolutely not. Markets always preempt. In the last 3 cycles, they preempted it by a fairly chunky amount, so it would fit in with the size of the last 3 cycles. So yeah, markets acting first, acting well ahead of time. This is completely usual, and we expect that to just continue and persist, pretty much until we get to that first rate hike. So yeah, expect lots of volatility while we're on hold, but a gradual uptrend over the year ahead. Okay, I'll finish there. Thank you.